Thanks for watching. We'll get you back to the second half of your game in just a moment. Investor Beat starts now. Thanks for watching. I'm Chris Hill, joined in studio by Jason Moser. I figure this weekend, March Madness, the opening weekend, only time anyone's watching this is like halftime of the game. So let's wrap up the week with some earnings news. We'll start with Nike. Third quarter profit and revenue looking good, came in better than expected, but shares down today on the guidance. They warned fourth quarter growth was slowing, and even into 2015 it's slowing. Is this a company in trouble?
I know. I would say first and foremost, no. Nike's not in trouble. It's a $70 billion company. Well, after today, maybe it's about $67 billion. But I mean, the market's right to be a little bit concerned about the China futures numbers being down. They're down about 3%. China brings in about 25% of the company's operating profit, so it's not insignificant. But look at all the positives here. I mean, they are doing a great job. Nike's doing a great job with their direct-to-consumer department. Really, those are important sales because it's higher margin, and it's really the direction things are going anyway. Sales on the internet, getting things directly to the consumer. And so, online sales grew 57%. Direct-to-consumer sales, that helped bring that whole segment up about 23%. And so when you look at that, you look at the power of this brand and the fact that they've got really adept management team behind it all, I've got no worries in the world. I think that long-term investors actually should look at Nike on days like this as an opportunity to either open a position or add to their position that they already have.
I was going to say, I know life isn't fair and the stock market isn't fair, but it seems at least a little bit odd to me that a company like this, as you said, global brand, a strong brand, operating very nicely, is getting dinged like this when we're seeing, certainly over the last year and a half or so, some of these companies coming public and the IPOs just shooting to the moon, and they haven't really proven themselves the way Nike has.
I think it's a great point you make there, and what we always say here at The Fool is it's about perspective, right? And we choose to take that long-term perspective. I think that's one of the individual investors' greatest advantages is if you can look at a company like Nike. I mean, these guys are still growing top-line revenue at 14%. I mean, for a big company like that, that's just phenomenal. And so if you have that timeline, if you can stretch that timeline out to 3, 4, 5, even 10 years, you can really open yourself up to a lot of great opportunities, and I think Nike's one of them.
All right, let's move on to Tiffany. A loss in the fourth quarter. There were some arbitration costs, but you look at same-store sales, particularly in North America, up 7%. Again, it seems like another mature company that is operating quite nicely.
It is, and I tapped Tiffany back in June of 2012 as a great opportunity, and the basis for that recommendation was there's room for growth, this tremendous brand that offered them some pricing power, and they're going to see some cost improvements trickle through the income statement, and that's what's happening really. So this quarter, you're right, they had an arbitration ruling in an agreement that was dissolved with Swatch, and really honestly, I think that's better off that they're not together. But the thing about Tiffany is we talk about just general retail, and we talk about luxury brands, and we see those kind of in-between affordable luxury brands. Tiffany is a luxury brand. There's nothing affordable about it, right? You're not going to see Tiffany resorting to fire sales. You're not going to see any Tiffany outlet stores. And so this is the kind of stock you really want to buy when the sentiment is just really south. I mean, in 2012 it was, rightly so. But what we've seen Tiffany do here over the past couple of years is really focus on maintaining that pricing. They were managing the business for longer term expectations. And what we've seen here over the past couple of years, the stock is up about 70%. It's thumping the market. And I expect that to continue. But when I look at Tiffany today, it's about 22 times the company's full year estimates. I don't know that I look at it as necessarily a value today. It's one that you can hang on to for a long period of time. But I'd rather buy something like Tiffany when the market's short term perspective is sending the stock price down.
All right, let's wrap up with Starbucks. No earnings news, but they had their annual shareholder meeting this week, announcing that something they've been testing in Chicago, Atlanta, and Southern California, they're going to start rolling out across the country, and that is the sale of beer and wine in the evening hours at thousands of locations. Not every location, presumably not drive-through, hopefully not drive-through. I don't know. Is this a good move? I'm a shareholder. Should I be happy about this?
Yeah, I think ultimately, yes. I think it's a good move. What it is Starbucks, they're not going to jump into something like this just willy-nilly, right? They've been testing this out in some markets here over the past couple of years to see if there was actually demand for it. And what they determined is in certain markets, there is demand for it. And so, Howard Schultz always talks about trying to make Starbucks that third place. He wants that to be the place where people want to go when they're not at home or they're not at work, another place to get away. and that's it. And when they open up this evening's menu and it brings alcohol and some new food offerings onto the plate there, it gives people a reason to be there, to stay there, to go there at a different time during the day. And again, like you said, it's not at every store. It's only going to be in markets where it's really where the demand exists. And you know, Schultz was very clear. This is not going to be. It's not going to be some kind of a driver to the business like coffee is today. It's going to be an incremental boost to their revenue, and I think they'll continue to do it very well. They're going to focus on getting the sort of smaller beer names and microbrewery names, and there's some, you know, a small offering of some good quality wines, and I think it'll attract you know, a demographic that'll continue to go back for more.
Also moving to alcohol this week, kind of an unlikely choice. Red Robin Gourmet Burgers rolling out a combination white wine, vodka, mango puree, and vanilla soft serve. On the face of it, this seems bizarre, but the more I step back and think about it, you know what? We've talked before about alcohol and what a driver that can be. At a minimum, I think you don't bet against them on this.
No, I wouldn't. And you know what? Red Robin does burgers, and they do them very well. And what goes better with burgers than a shake? I mean, personally, I'm a bit more of an IPA guy. I like my beer, but I also get where they're coming from with this milkshake. It's something that you probably can't get anywhere else, I imagine. And so, is it something that's going to drive the top line for this company? No, but it's certainly going to create interest, and I bet you they'll have some patrons that go in there that want to try it out. And hey, you got to love it when food and beverage companies, restaurants, when they get a little bit experimental. They try new things. I like that. It means forward thinking, you know, always thinking ahead, trying to figure out how to, you know, expand their offering.
How closely do you think McDonald's is watching, particularly the Starbucks experiment? Because if McDonald's at any point decides to go the route of selling beer in its locations, that could be a little bit of a game changer.
Yeah, and I don't think that works for them either. You know, we always talk about brand recognition and sort of brand identity, and what McDonald's has done for better or for worse over the course of its life, it has developed a brand that's very identifiable with a value offering. It's not bringing those kinds of consumers in there, and so I wouldn't expect to see that coming from McDonald's anytime soon. And furthermore, if I did see it coming from them, I don't think it would succeed. So I'd say that's probably a pass on their part.
All right, that's going to wrap up this week's action. Let's look ahead to next week. What's a stock that you're watching?
You gonna go see the Muppet movie tonight?
I don't know about tonight, but probably this weekend. Yeah.
Muppets Most Wanted is out, and in that honor, I'm looking at Walt Disney. I mean, this is a company that just continues to bring the heat here with movies, whether it's Disney or Star Wars or whatever it may be. They continue to expand that offering and entertainment. They play just a part of our lives from when we're kids to when we're adults and we have kids. And you know, something they're doing that I think is really interesting is this Disney Accelerator program, where they're bringing in small startup businesses. They're going to mentor, you know, up to 10 small businesses in the tech and entertainment industry, provide them with some startup capital, and really try to grow, you know, presence for these companies that'll kind of be a part of our future down the road as well. I love to see big companies like Disney doing that. That means they're really trying to be a part of the solution. And so for me, I like that. I'm going to probably go see the Muppet movie here in the next few days. I know my kids will love it. So, you know, Disney, it's a great company, great stock. If you don't own it, I think it's one worth keeping on your watch list.
We have a review for us next time?
I guarantee it.
All right, for Jason Moser, I'm Chris Hill. Thanks for watching. We'll see you on Monday.